When diving into rental property investment, many new investors can be overwhelmed by the technical jargon, complicated calculations, and the sheer volume of factors that determine whether a property is a good investment. However, at its core, rental property investment boils down to one simple concept: cash flow. Understanding cash flow can be the key to ensuring the financial success of your rental property, and once you break it down, it becomes a lot more approachable. In this speech, we'll go over what cash flow is, how to calculate it, why it matters, and how you can use it to make smarter investment decisions. To start, let's define cash flow. In the context of rental properties, cash flow is the amount of money you make after all the expenses associated with a property have been paid. In simple terms, it's the money you have left over after paying your mortgage, taxes, insurance, maintenance costs, property management fees, and any other expenses that come with owning a rental property. If you're making money from your rental property each month, that's positive cash flow. If you're losing money, that's negative cash flow. Positive cash flow is the goal, and it's the indicator that your property is financially healthy. So why does cash flow matter so much? Think of it this way. Positive cash flow allows you to continue to build wealth through your property without having to dig into your own savings or income to cover the property's costs. It provides you with a steady stream of income, which can increase your financial security, fund future investments, or even allow you to quit your day job if your cash flow is substantial enough. On the other hand, negative cash flow means you're losing money every month, which can quickly drain your financial resources and put your investment at risk. Cash flow is the lifeblood of rental property investing. It's what keeps the property running and supports your long-term financial goals. Now that we understand why cash flow is so important, let's take a closer look at how to calculate it. To calculate your rental property's cash flow, you need to account for all of your income and all of your expenses. This is where the numbers start to come into play. The first part of the equation is your rental income. This is the amount you're receiving each month from your tenants. Rental income is typically the easiest part to figure out because it's the amount of money you agree to charge your tenants. Let's say, for example, that you rent your property for $1,500 a month. That's your rental income. Next, you need to subtract your operating expenses. Operating expenses include everything it costs to maintain and manage the property. These expenses might include mortgage payment. This is often the largest expense that includes both the principal and interest portions of the mortgage. If you're financing the property, your mortgage payment could be anywhere from a few hundred to a few $1,000s, depending on the size and price of the property. Property taxes, these vary depending on the location of the property. You'll need to check with local authorities to determine the annual tax rate and then divide it by 12 to get the monthly amount. Insurance. Property insurance is a necessary cost for protecting the property against damages such as fire, theft, or natural disasters. This is typically a yearly expense, so you'll need to divide it by 12 to get a monthly estimate. Maintenance and repairs. Even if your property is relatively new, things break. Roofs leak, HVAC units stop working, and plumbing issues arise. It's important to set aside funds for ongoing maintenance and unexpected repairs. A good rule of thumb is to set aside 1% of the property's value each year for maintenance, though this can vary depending on the property's age and condition. Property management fees. If you hire a property management company to handle the day-to-day tasks of renting out your property, they typically charge a percentage of your rental income, often around 8–10%. For a $1,500 per month rental, this could be 20. Utilities. In some cases, landlords pay for certain utilities, such as water, trash, or electricity. If this is the case, you'll need to factor in these costs. HOA fees. If your property is located within a homeowners association HOA, you'll need to account for any monthly or annual HOA fees. These fees can vary widely depending on the amenities and services the HOA provides. Once you've accounted for all these operating expenses, you can subtract the total from your rental income to determine your net operating income, NOI. The formula looks like this. Rental income, operating expenses is net operating income. Now, to calculate cash flow, you need to go one step further. You also need to account for your mortgage payment. As this is not part of your operating expenses, the final formula for cash flow looks like this. NOI, mortgage, payment, cash flow. So let's look at an example. Let's say your monthly rental income is $1,500. Your operating expenses include mortgage payment, property taxes, insurance, maintenance and repairs, property management fees. Your total operating expenses come to $1,500 rental income. $1,420 operating expenses, Now, let's subtract your mortgage payment. $80, no I, $1,000 mortgage payment, a 920 negative cash flow. In this scenario, you're losing $920 a month on the property. This means that you'd be relying on other sources of income to cover the shortfall, and this property wouldn't be a good investment unless you could adjust some of the variables, perhaps by increasing the rent, reducing expenses, or refinancing the mortgage to get a better interest rate. Of course, not every property will be negative cash flow. In fact, one of the goals of a successful rental property investor is to generate positive cash flow. This means that after all expenses, including your mortgage, you have money left over. If your monthly rent is $1,800 and your operating expenses, including your mortgage, are $1,600, your cash flow would be $1,800 rental income, $1,600 expenses, a $200 positive cash flow. That $200 a month is the money you're putting in your pocket. It's the money you can reinvest to use to pay off debt or keep as personal income. Achieving positive cash flow isn't always as easy as it sounds. Sometimes it requires you to be strategic. If you buy a property in a high demand area, you may be able to charge higher rents. Or if you can manage the property yourself, you'll avoid property management fees, which can make a big difference. Additionally, if you're buying a property with an existing tenant, you may be able to negotiate a better deal on the purchase price, which will help improve cash flow. But it's not all about maximizing rent and minimizing costs. You also need to consider the long-term appreciation of the property. While cash flow is important, so is the potential for the property to increase in value over time. Some investors buy properties with the expectation that the property's value will rise, allowing them to sell it later for a profit. This is an example of how cash flow and appreciation can work together. Even if your property isn't generating a huge amount of cash flow right now, if the property appreciates significantly over time, you can still make a solid return on your investment when you sell. In conclusion, understanding cash flow is one of the most important skills for anyone looking to invest in rental properties. It's what will ultimately determine whether you're making money or losing money on your investment. By calculating your rental income, expenses, and mortgage payments, you can get a clear picture of your cash flow and determine whether the property is a good investment. Keep in mind that there are other factors to consider, such as the potential for property appreciation and the amount of work required to manage the property. But by focusing on cash flow, you'll have a solid foundation to make informed and profitable decisions in your rental property journey. Cash flow is the most important factor in determining whether a rental property is a successful investment. In simple terms, it refers to the amount of money that remains after all the expenses associated with the property have been covered. This includes everything from your mortgage payments to property taxes, insurance, maintenance, and even property management fees. Cash flow essentially measures the profitability of your investment on a monthly basis and provides insight into whether your property is making money or losing money. Understanding cash flow begins with recognizing that rental income is not the only financial component of owning a rental property. While rental income, or the amount you charge your tenants for rent, is the most straightforward revenue, it doesn't account for the ongoing costs that come with maintaining and managing the property. These expenses, which we can call operating expenses, include mortgage payments, which usually make up the largest portion, property taxes, homeowners insurance, maintenance and repairs, property management fees, utilities, and any other costs related to the property. If you're not careful, these expenses can quickly eat into the rental income you receive. When you subtract all these operating expenses from your rental income, you're left with your net operating income, NOI, which gives you a good idea of how the property is performing financially. From there, you need to subtract your mortgage payment to get your true cash flow. If your expenses are greater than your rental income, you'll have negative cash flow, which means you're losing money every month. On the other hand, positive cash flow means that after all expenses, you're still generating a profit, making the property a financially viable investment in the long run. Understanding this concept is crucial for ensuring that your investment continues to build wealth rather than drain your resources. To accurately calculate cash flow, it's essential to account for all the expenses that come with owning and managing a rental property. These costs can vary significantly depending on the location, size, and condition of the property, but there are some common expenses that all landlords need to factor in to determine whether their rental is profitable or not. One of the most significant expenses is the mortgage payment, which typically includes both the principal and the interest. This is often the largest outgoing cost for a property owner, and it must be deducted from rental income. If you're financing the property, the mortgage payment will be a fixed monthly amount. But remember to consider interest rates and how they can fluctuate, especially if you have an adjustable rate mortgage. Next, property taxes are another essential expense. Property tax rates vary widely depending on the region, so it's important to check with local authorities to understand how much you'll owe each year. To make this more manageable, divide your annual property tax bill by 12 to determine the monthly cost. Ignoring this expense could lead to an unexpected financial burden. Insurance is another key cost to consider. Landlord insurance protects the property from risks like fire, theft, or natural disasters. Unlike regular homeowners insurance, landlord insurance also covers damages caused by tenants. This is typically a yearly expense, so you'll need to break it down monthly to get a true picture of your expenses. Maintenance and repairs should not be overlooked. Regular upkeep is necessary to keep the property in good condition and to avoid costly emergency repairs. A general guideline is to set aside 1% of the property's value each year for maintenance, though older properties may require more frequent repairs. Additionally, if you hire a property management company, their fees will be another recurring expense. Property management companies usually charge a percentage of the monthly rent. Often even if you manage the property yourself, you should still account for any costs related to marketing, tenant screenings, or hiring contractors for repairs. Finally, utilities may also be an expense if you, as the landlord, cover certain utilities like water, gas, or electricity. These expenses can add up, especially in multi-unit properties, so it's important to determine in advance whether you or your tenants will be responsible for utilities. If you do cover them, you'll need to calculate the monthly average costs to include in your cash flow calculations. In sum, a thorough understanding of these key expenses ensures that you're not blindsided by hidden costs, and it helps you more accurately predict the property's cash flow and overall profitability. Achieving positive cash flow in rental property investing often requires more than just purchasing a property and collecting rent. It involves making strategic decisions that maximize rental income while minimizing expenses, ensuring that the property remains a profitable investment in the long run. One of the first strategic decisions is the location of the property. Location plays a crucial role in determining rental rates and tenant demand. Properties in high demand areas, such as close proximity to public transportation, schools, or employment centers, tend to attract higher paying tenants, which can lead to better cash flow. It's essential to research neighborhoods considering both current rental rates and potential for future growth. A good location not only increases your chances of maintaining consistent occupancy, but can also allow you to charge premium rent, which boosts cash flow. Another key decision is how you manage the property. Property management can be a significant cost, with management companies typically charging 8 to 10% of the monthly rent. If you have the time and skills to manage the property yourself, this can free up a portion of your rental income that would otherwise be spent on management fees. However, managing a property comes with its own set of responsibilities, such as handling tenant issues, ensuring maintenance is done on time, and marketing the property when vacancies arise. If you choose to manage the property yourself, be sure to budget for potential costs like advertising, tenant screening, and contractor fees for repairs. Moreover, making improvements or renovating the property can be a smart way to increase rental income. Upgrading kitchens or bathrooms, adding desirable amenities like laundry machines, or improving the overall aesthetic can help justify higher rents. Even small changes, such as installing energy-efficient appliances, can appeal to tenants while lowering utility costs, benefiting both you and your tenants. One often overlooked strategy is to optimize expenses through cost-saving measures. For example, keeping maintenance costs under control by setting aside a regular maintenance budget can prevent unexpected costly repairs. Using reliable contractors, performing routine inspections, and addressing minor issues before they become major problems can significantly reduce maintenance expenses over time. You can also look into refinancing your mortgage to lower monthly payments, which directly increases cash flow. Ultimately, achieving positive cash flow is a balancing act between maximizing income and controlling expenses. Each decision, whether it's location, property management, renovations, or cost-saving strategies, requires careful thought and planning. By taking a proactive approach and constantly assessing your property's performance, you can ensure that your rental property generates a steady stream of income, providing long-term financial stability and growth.